agreement that they've announced explains why that stock has popped up a little bit. I think it was trading in the red at the start of this hour. It's moved to the high point of the day as we speak. But as promised, let's get going with our chat on IMFA. Mr. Subhrakant Panda, who is the Managing Director of the company, joins us on the show. Hi, Mr. Panda. Good morning and thanks so much for joining in. Well, there are two pieces of news that we need to address today. One is you've thrown out a sweetener for your shareholders and given them a big dividend, so they'll be happy about that. And the other one is your diversification plan. Let's take the dividend first out of the way. Now, the total dividend payout will be around 81 crores approximately. So post this dividend payout, what is effectively the cash in books? Point number one. And also the total quantum you had to receive as compensation for that Utkal C block was around 350, 380 crores approximately. You have received around 131 odd. How much is pending and by when we'll get it?
So, Nigel, this has been a long-running saga, and I'm glad that we have at least got the first tranche in the kitty. And as you correctly mentioned, about 131 crores has been received. And what that means is that the balance amount which we are entitled to get as per the final compensation order is roughly another 221 crores towards land, and mines infrastructure will be somewhere about 18 to 20 crores. So all in all, about 240. So what had basically happened was that the new allotee had challenged the final compensation order, and what the nominated authority has decided to do is to release the undisputed amount, which works out to 131 crores. But we do expect the balance amount to also come in soon. For the simple reason that the tribunal has refused to give any stay on the final compensation order, and that is why we are taking it up with the authorities, and we do expect it to come into the kitty soon. Now, the specific questions that you asked in terms of the balance sheet position post the special dividend. So cash in the books would be we are in a very, very strong position, fortunately. So cash in the books is about 350 crores. And undrawn working capital limits beyond that. So as I have been saying repeatedly that we have a very strong balance sheet, and as we embark on our expansion and diversification plans, we are in a position to do that practically without taking on any debt. And this is of course an ode to the hard work over the years and the strength of the fully integrated business model.
All right, Mr. Panda, congratulations on receiving at least the first tranche of the money, and shortly the second tranche would come about as well. I remember us having a conversation for every quarter. We'd keep asking about this. In the last conversation we had as well, you said the next time we speak, there will be clarity on that. So good on you. But now the diversification, as Nigel pointed out, the dividend was one. The other part is the diversification itself. Ethanol business. I mean, what explains the rationale for metal and ferro alloy companies to go into ethanol? And with the kind of investment that you've earmarked for this, what is the kind of return, asset turns or margins that you expect?
So, we need to understand why we're doing this. And, it is a diversification, but it is not something which is going to make a big difference in terms of either our management attention or, resources that we're looking to commit to this. Broadly, our Therubali unit has surplus land available as well as allied infrastructure. Which, while we are producing ferrochrome in 3 furnaces there, we are not going to add any more capacity in Therubali specifically because of logistical disadvantage. And that's why our expansion plans, which is 2 phases, 100,000 tons coming on board by early 2026. And we already have the state government approval for the second phase as well, which we will take up subsequently. So all of that is coming up in Kalinganagar in Jajpur district, which is closer to the mines, which is closer to the ports, which is closer to domestic stainless steel capacity in Kalinganagar itself. So that is where we are looking at our ferrochrome expansion. So the idea behind looking at a small investment in ethanol was to really utilize the surplus land which is available as well as the allied infrastructure, because this is going to be grain-based. And we have the railway sidings and everything else to handle bulk material. Now, while we have taken board approval for about 200 crores, the project cost itself, including land, which is already available with us, is roughly about 150 crores. And once you take land out of the picture, the actual outflow in terms of investment will be probably 100, 110 crores, which means the equity investment is minimal, really. And so what I wanted to assure all stakeholders is that we have not forgotten that our core competence is ferrochrome, and that is what we are going to focus on. This is just a minor sideshow, if I can put it that way, to utilize the land and allied facilities, which is not going to either detract from management attention or require substantial investments.
Just a question, sir. This land that you had, since it was surplus, you couldn't find a buyer for it and maybe, realize some money?
So, this is the interior Odisha. This is something that, I don't think there is anything that can really come up there. At one point in time, we were, of course, considering expanding our capacity there. But as I mentioned, the logistical disadvantage is such that it doesn't make sense for us to put up any capacity there. And, I think it is much, in terms of, what this project will give us, broadly, we're looking at about, 200 plus crores in terms of turnover with an EBITDA margin of about 20%. So I think that's a much better option for us as opposed to looking to sell the land.
Just to clear this in, sir, you're going to be putting down 200 crores as an investment. The asset turn will be around 200 crores per annum with margins of around 20%. Effectively, you're doing the similar margin. So it won't be margin dilutive at all. In fact, it will be at par with what you're doing.
Not at all. And in fact, the project cost is probably about 150 crores. And if you take, which includes land. So if you take that out of the picture, the actual outflow in terms of investment is maybe 110, 120 crores. And the equity component is a fraction of that. So really, nothing substantive either in terms of, the resources that we are committing or management time that is going into it.
And by when does this happen? The 200 crores is from FY26 or FY27?
So we are looking to start construction sometimes later this year. One of the reasons for also applying before March 31st is that there is a special dispensation where you don't need environment clearances, etc., for green projects if applied before the financial year end deadline. So we're looking to start construction perhaps, I would say about 5 to 6 months' time and roughly about 18 months' time.
So I guess it's an FY27 story as against an FY26 story.
Absolutely. And which is when our core expansion, which is the 100,000 tons per annum Kalinganagar plant will also come online. And, just to talk a little bit about the fact that FY24 has been a very, very good year for us operationally. And we are generating the sort of surpluses that we need to have in place to focus on our expansion projects as well.
Just to follow up on the investment that you're making, about 110 crores equity x land, you expect an EBITDA margin of close to 20%
not equity,
crore
not equity. Equity will be, that's the total outflow in terms of capex. So equity will be a fraction of that.
Okay. So what does this do to your return ratios? Because, you get close to 40 crores in EBITDA in FY27 on a capex that you're making of close to around 110 crores.
That's right. So as I said, it's not something which makes a significant difference to our top line or bottom line. It's just something that we feel is better use of the surplus land and infrastructure which is available, as opposed to letting it either lie idle or as Nigel suggested is selling that an option. We don't believe so. So this is something, and again, as we mentioned in terms of returns, it is definitely going to be value accretive. So it's just a small sort of attempt to utilize the surplus land which is available without in any way losing sight of the fact that our strength and our core competence is ferroalloys, and which is exactly what we are focusing on in terms of expanding our capacity, which we are already sort of underway.
Just going by the numbers, it appears on a return basis, on a ratios basis, it could be actually better, this investment that you're talking about, because you're talking about 40 crores on an investment of roughly around 110 crores. We'll wait for it to come on stream, but as you're saying, it's a story for FY27. Getting back to the core business then, the ferrochrome business, when does this expansion go live?
So, what we have been indicating is that there has been a slight slippage in terms of getting possession of the land due to administrative issues, and obviously with elections and etc. that sort of slows down things a little bit. So we are on track, I would say, to commission the first furnace in early 2026, and basically broadly have the entire capacity available for most of FY27. And from that point of view, we have already placed major equipment orders, which are the long lead items, and we expect to sort of kick off construction later this year post monsoons.
Okay, all right. So then your capacity will go from around 280,000 to around 380,000, right? Post this expansion?
That's right. So 284,000 is the current capacity. 100,000 is what we are adding.
And then post that, you're looking at adding further capacity?
Absolutely, yes. So after that, we also have state government approval for the second phase, which will be broadly another 150 to 200,000 tons of capacity. And all of this, of course, goes lockstep with our increase in ore output, because that is the starting point of the value addition cycle.
Got it. And, sir, with both these two expansions, that's the ethanol business as well as the phase one that you have planned, you'll continue to remain a net debt-free company? Internal accruals will be good enough?
Absolutely. As of now, with the forecasts that we have in terms of the next 2 to 3 years, we do not expect to take on debt. I think net debt-free is the better way to look at it, because strategically we may decide to take on a little bit of debt and balance that out with cash on the books, so as to have flexibility available with us.
Okay, all right. Mangalam, and we'll be looking forward to having a chat with you at the end of the quarter once you declare your quarter four numbers. But just directionally, it appears that quarter one could be better in terms of margins in comparison to quarter four. And I say this because I'm looking at the ferrochrome trends globally, and you export most of what you produce. And also coking coal costs have cooled off, and you're getting your chrome ore from your own backyard. So margins directionally in quarter one or the first half of the next fiscal could be better than quarter four?
That is certainly what it looks like. Do keep in mind a couple of things, which is that as far as the benchmark price for quarter one is concerned, that went up by about 8 cents. Net, we expect an increase in realization between 5,000 to 6,000 rupees a ton for prime product. But there is a little bit of cost pressure as well, because what you're referring to, coking coal prices cooling off. Do keep in mind that we are consuming metallurgical coke, which has been procured 4 to 5 months ago. So we are expecting a slight bump up in terms of our metallurgical coke costs for Q1. Also, the renewable energy requirements are going up, so that will add a little bit of cost, as well as some maintenance activities, one-off maintenance activities that we are taking during end of Q4 spilling over into Q1. So all said and done, there's a little bit of a cost pressure as well. But net, we certainly expect to do better than Q4. And if I were to look at the first half of the year, and again, Nigel, you're aware that I'm wary about talking about anything beyond 6 months forward. But the first half of the year, I would say, looks good, because especially once the rate cut cycle starts happening globally, that is going to provide a boost to commodities. China is also sort of pulling out of its slump with the manufacturing PMI picking up beyond 51. So all signs point towards a good first half, building on what has been an exceptional FY24 operationally, because I'm glad to tell you that we have registered an all-time high in terms of outputs, about 2.64 lakh tons, 264,000 tons. Our ore output is at an all-time high. So all of this, is sort of setting us up very nicely for the coming year.
Okay. All right, Mr. Panda, always a pleasure talking to you. Thanks so much for coming in and clarifying on the dividend payout as well as the diversification plans. We have a date with you, post your quarter four numbers, and we'll get further clarity on that front.
Absolutely.
Well, let's move on then. Here's a quick programming note. CNBC-TV18 presents India Exchange, where market experts and industry stalwarts will collaborate in insightful discussions on India's economic path and the evolving dynamics of the Indian market. Don't miss out on this. Tune in to CNBC-TV18 on April 4th at 5:30 p.m. onwards.